Hello, this is Professor Randy Menton, and today what we're going to do is go over the adjusting entry process that we find at the end of Chapter 3, and I'm working here with the continuing problem. As you'll recall, we in Chapter 2 worked the continuing problem up to the point where we had created a bunch of journal entries, and I'm showing those here now. We go up through the screen. And after we did the journal entries, we posted those to T accounts, which we'll call a ledger, because a ledger really is nothing more than a glorified T account. And then, once we have posted them to the ledger, we put them in the unadjusted trial balance. Now, if I look at the top of page 147, what you're going to see is the unadjusted trial balance for PS Music. And as you look down through the unadjusted trial balance provided here and the one on page 147, you see that they're the same. So we've to this point we've got everything correct. So let's go back over to the journal and come down to where I've created an area for excuse me, for adjusting entries, and start working through the adjusting entries, because that's what the instructions tell us to do. They say that we're to prepare adjusting journal entries. You will need the following additional accounts: 18 accumulated depreciation, office equipment; 22 wages payable, 57 insurance expense, and 58 depreciation expense. Let me just pop over here to my adjusted trial balance, because it's been a while since I looked at this, and see, yeah, it appears as though I have created those accounts and already put them in here, so I didn't have to do them on the fly. Okay, so those accounts have been created. Now all we need to do is walk through the adjusting entries and then post those adjusting entries to the adjustments column of the worksheet, and then from there we'll create a balance sheet and income statement. Okay, so we'll do that in Chapter 4, and I'm just going to I'm going to let Chapter 3 and Chapter 4 run together here, so that we take care of both of them at one time, since I'm a little late getting this posted. Okay, the first adjusting entry is: during July, PS Music provided guest disc jockeys for KXMD for a total of 115 hours. For information on the amount of the accrued revenue to be billed to KXMD, see the contract described in the July 3rd, 2016 entry transaction at the end of Chapter 2. Okay, well, let me just remind you what we agreed to, or what PS Music agreed to, versus with respect to KXMD. What was said was that they were going to provide 80 hours per month worth of disc jockey services for $3,600, and any hour above the 80 hours they were going to provide at $40 per hour. So what we've done here is we've created 115 hours worth of services, and we've only billed for 80 of those. Now also remember, let me just refresh you on one of the other entries that happened in Chapter 2. We had $7,200 paid up front for the months of July and August, and so we had a debit to cash for $7,200 and a credit to the unearned revenue for $7,200 to get that to recognize that liability. Okay, so now what we're doing is we're picking up this additional amount of time at the $40 per hour rate. So where does it go? Well, since we're not getting cash here, it must be accounts receivable. Accounts receivable is an asset. It goes up on the left-hand side and down on the right. Its number here that we've assigned it is 12. So accounts receivable, and the amount is going to be $1,400. Now it's already out here because I went ahead and created the formula for it. And basically, if you look up here at the top, here's the formula. It's 115 hours minus 80 hours times $40 per hour, and that yields $1,400. Now, these represent hours in money that has been earned. So these are fees that we're charging at this point that have been earned and are therefore we're entitled to them in terms of our revenue stream. Our revenue stream is fees earned. So I think that was 41, and it was, and that's going to be the credit that we use in this particular entry. A debit to accounts receivable. It's an asset going up on the left hand or debit side. We have fees earned, which is a component of stockholders' equity. It's going up as well. It's on the right hand side of the equation, and therefore it's being credited because it's increasing. Okay. B. Supplies on hand at July 31st, $275. Well, in order for us to be able to make this entry, what we need to know is how much is on the books currently. So I'm going to pop over here to the unadjusted trial balance very quickly, and I'm going to look at the supplies account, and I see that there's $1,020 in the account. Well, what they're telling us is that after adjustment we should only have $275 in the account. So since supplies is an asset, goes up on the left hand side, we have to make an entry crediting supplies, and the debit side of that entry is going to be an expense. And this is what we typically do. We're going to move an expense, an asset into an expense account representing the fact that we have used it up. So let me run over here to the adjusted trial balance. I need to see what the supplies expense account is, and it's 56. So I'm going to come back over here. 56 is supplies expense, and now the entry is going to be for $745. And you'll excuse me for having already prepared these, but I'm trying to make this move a little more quickly through the process. And so how did I come to that? Well, 1,020 was the amount in the account, and 275 is the amount that should be in the account. So if I subtract one from the other, what that gives me then is the amount that is actually needs to be in the expense and needs to be reduced from the supplies account in order to make it come down to its proper value. Now I want to say that the supplies account is 14. That may not be right. It is. Okay. So supplies now is being credited. Supplies is an asset. It is on the left hand side of the accounting equation. It means it goes up on the left and comes down on the right. Since I'm making an entry to the right hand side of the account, I'm reducing the value of supplies. I'm increasing the amount in the supplies expense. Supplies is a component of stockholders' equity. It's on the right hand side of the account. Things that go up on the stockholders' equity side go up on the right and come down on the left. All expenses are normal debits, but they all reduce stockholders' equity, so you can see the logic that's still existent in that move. Okay. C. The balance of the prepaid insurance account relates to the July 1, 2016 transaction at the end of Chapter 2. And I can't recall, so I'm just going to pop over here and cheat a little bit. I thought it was $2,700, and it is. Here's what we did. On the 1st of July, or the 3rd of July, something like that, we bought an insurance policy for the entire year for $2,700. So we're now at the end of the first month. So what we would have to do is we would have to expense 1/12 of that $2,700. Now, prepaid insurance is an asset. So when it goes up on the left-hand side because it's on the left-hand side of the basic accounting equation. It also comes down on the right-hand side of that equation. So in this particular case, we're going to need to have a credit to prepaid insurance. And what we're going to do is we're going to debit the expense. Now I think we created the expense, and I think we gave it a number of 58 maybe? No, maybe 57? Yes, we gave it a number of 57. So if I look over here, we have, oh, wait a minute here, is this correct? I have to look back at the entry now. A little bit, these things are a little bit cold on me, so let me take a look back and make sure that I'm treating this correctly. I want to say that we just take a month of that. I'm sure we do. I won't take but a second here. Let me just make sure that this is the month of the month of July. So we have to change this entry. It's actually just dividing it by 12. And when I do that now, it should drop it to 225, and I think that is in fact the correct amount. Okay, so insurance expense is charged for 1 month, so $2,700 divided by 12 is $225. And what we're also going to do is we're going to reduce the prepaid insurance asset account, the same thing we did with supplies over here. And prepaid insurance is account number 15. So there we are with the $225, which represents a reduction of prepaid insurance. Okay. D, depreciation on the office equipment is $50. Now, they didn't make us actually do the calculation here. They could have made you do a calculation, but they didn't make you do that. And all they said to do was to go through and make an entry to reflect the fact that some of the asset is being used up. Now, instead of having an asset being credited here, we're going to credit this contra asset called accumulated depreciation. And the reason we do that, instead of taking it against the asset, is so that we can more easily calculate gains and losses. And I'm sure there's another theoretical reason for it as well, but that's really all you need to know at this point. So we're going to charge the expense, which is depreciation expense, and I think we, whoops, 58 is the depreciation expense for $50. And the other side of that account is the accumulated depreciation contra asset, again for $50. Okay, so that takes care of that one. Excuse me. E, the balance of the unearned revenue account relates to the contract between PS Music and KXMD described on the July 3rd, 2016 transaction at the end of Chapter 2. And that's the one that I was referring to earlier. What we did is we got $7,200 in cash, representing 2 months of payment. Now, when we got it, we had to set it up as a liability because we hadn't performed any services. Now we're at the end of the first month. We have performed 1 month's worth of services. So now what I have to do is I have to take it out of the liability, because I no longer would owe it if we cancel the contract for some reason, and I have to put it into the actual fees earned. So I'm transferring it from unearned revenue to earned revenue. That's all I'm really doing. And again, I'm going to have to pop over here so that I can see what the unearned revenue account was, and it was number 23. So 23 is going to be debited. And the reason I'm debiting it again is because it's a liability. And liabilities are on the right-hand side of the accounting equation, which means they go up on the right and down on the left. This one is coming down in the amount of $3,600. And I'm now charging fees earned, the 41 account, for the fact that we've actually earned some revenue. Okay, next item. And I guess it's actually the last item, isn't it? Accrued wages for July 31st of 2016 were $140. Well, what this means is that we came to the end of the month of July, and it's not a payday. It's not a payday, so we have to accrue. That is, we have to set up a liability and an expense for the amount that we actually owe at the end of this period. So how would we do that? Well, we're going to debit the expense, wages expense, and we're going to credit wages payable. So we set up the wages payable, I think just a moment ago, with 22, but we have to find the wages expense, which is 50. So coming down here, 50 is wages expense, and it's for $140. Again, they didn't make us calculate this. They could have, but they didn't. And the other side of it is 22, which is the payable. Whoops, 23, which is the payable. No, it isn't. 22. There we go. It's late. And I didn't put any explanations down underneath each one of these, but typically you would say, you know, that this one's this and so forth and so on. Now, I have to look at something here because I'm wondering if when I came down through here, okay, I just wanted to make sure that I didn't have these entries put into a position that would not be picked up on the unadjusted trial balance when I moved it over. Okay, now typically what you would do is you'd make these adjusting entries to the ledger and go from there. But we're not going to do that. We're going to put these adjusting entries directly in the adjusting entries column of the worksheet. Okay, so now what I would do is I would come over here, and my first entry is accounts receivable for $1,400. So I'd come over here and it's a debit. So I would debit accounts receivable for $1,400, and I would come down to fees earned, and on the fees earned side I would credit that for $1,400. Now I'm not going to do that because it's going to take too much time for both of us. So I just want you to know that all I'm going to do is take each one of those entries and post it over here to the adjusting entry column. If it's a debit on the journal, it's a debit over here. So if I do that, what happens if I come over here and I make this, if I come over here and say yes to this or Y to this, I've set it up to where it automatically posts all of these adjusting entries. And I'll just kind of walk you down so that you can see some of them here. Now, the only one that's kind of an aberration is the fees earned, because we had two entries going into fees earned, so I had to make a little bit of an adjustment in the way that I picked these up. But you can see that there's $1,400 here, $3,600 here, and the total of those is equal to $5,000. Everything else is a one-to-one relationship. So here's your supplies expense of $745 and your credit to supplies. Here's your insurance expense of $225 and your credit to prepaid insurance. Your depreciation debit of $50 and your credit to accumulated depreciation. And I did that all the way down through there, and we have a $60,160 number on both sides. Now, to finish up Chapter 3's problem, we have to have an adjusted trial balance. And the way that we get the adjusted trial balance is quite simple. Okay, if I'm in the debit column here, okay, so if I have a debit over here, then I'm going to have a debit over here. So if I start out and I have a debit, do I have any debits here? No. Do I have any credits here? No. If I had a debit, I'd add it. If I had a credit, I'd subtract it. So that's not the case here. In this case, however, we have a debit here and a debit here, so I would add those two. In this case, I have a debit here, a credit here, so we subtract one from the other. And remember that this will be the one that will show you that everything is working, because remember, that's the one where we had I think it was $275 that was left in the account. We'll find out here in a second, because I'm just going to, in this column, I'm going to put another Y and let this fill in. And there you can see that's the $275 that they told us existed in the account. So if I look down through here at all of these numbers, and simply I'm just pulling them across. This was $2,800. I had a $140 debit going to a $2,800 debit, $2,940. All of these just came across. This didn't have any beginning entry, the 225 and the 50, so when I put them in as an adjustment, I just added them over here as well. So this is simply just adding likes and subtracting unlikes, as we always do, and I came up with $42,340. If I look in my book and I look over on the on page 146 on the left, it says the total of debit column in the solution of this problem is $42,340. I have $42,340 on both. So I'm good to go, no problems, and that concludes this problem. Now what I'm going to do is I'm going to now come back with the same worksheet in chapter 4, and I'm going to complete the worksheet, but I have a little bit of work to do before I can get there. So I'm going to end this one and post it, and then I'll come back and do the chapter 4 and post it as well. So thank you very much for your attention, and I'll see you here in a few minutes with the other problem.